Hi, everyone. I'm Sarah Samuels. I'm a partner at NEPC, overseeing our investment manager research team. And I'm joined here today by 5 senior leaders within our investment manager research group. And these leaders represent every major asset class that we cover here at NEPC, including private markets, hedge funds, and long-only marketable strategies. So what we're going to do today is we're going to hear from each of these leaders, and we're going to learn a little bit about what they're seeing on the ground, meeting with investment managers, and allocating capital. They'll provide some guidance as to how to think about the coming year, as well as some risks that they see on the horizon. So first, I'd like to start with Dilari. Dilari is a partner, and she is head of our credit and multi-asset teams. So Dilari, traditionally diversifying strategies shifted their profile in 2022. And many investors did not get the results that they expected from treasuries. So maybe tell us about how you approach diversifying strategies on your team.
Sure. Thank you, Sarah. Hello, everyone. So as Sarah mentioned, multi-asset is a team, under our purview, which covers a wide gamut of strategies, but the key role for those strategies is diversification. And I think diversification proved its value in 2022. So from that perspective, strategies such as global macro, fund of funds definitely have a role to serve in the portfolio going forward. What we are actively recommending in 2023 is to at least have or maintain or create a new allocation to broadly diversified global macro strategies. And in case if you already have some in your portfolio already, maybe think about rebalancing back to its original allocation, because it's probably given the outperformance, right? Some of these strategies probably grown a lot in 2022.
Excellent. So recommend clients look at global macro, think about diversifying strategies with a broader aperture than just treasuries, and rebalance away from global macro. Excellent. So moving on, you also oversee our entire long-only credit suite. So where do you see on the credit side the most value today, both from a beta and from an alpha perspective?
Yeah, credit is certainly looking really attractive in 2023 after a long time. Today, let's take investment grade, for example. It's investment grade bonds are giving a pretty decent compensation relative to treasury. So I think it's a great way to access fixed income beta, either allocate through core plus, so high grade strategies, as well as some relative value trading in high grade. From a return seeking credit standpoint, which we include high yield bank loans, emerging market debt, and some hedge fund credit strategies. I would say we prefer to stay nimble through some multi-sector credit funds that can tactically rotate capital dynamically amongst bonds and loans and lean in as needed into some return-seeking opportunities. For clients that can access complex strategies or have an appetite to go illiquid, looking at some distress credit opportunities within the hedge fund space will definitely offer some premium. There are also some crossover trading opportunities, and these crossover funds are the ones that straddle between hedge funds and private debt strategies. It's a continuing spectrum of investments that are available to investors, which we think will be appealing this year onward. And last but not the least, I would say, definitely when you're sourcing liquidity from fixed income allocation, to keep in mind that some of these portfolios under your funds definitely have some recovery built in 2023.
Thank you, Dilari. So this is a nice transition. We're going to hear from Oliver Fadley next, who is a principal and head of our private debt team. Oliver, at NEPC, we spend a lot of time working to embrace a CIO mindset. So to think very deliberately across the liquidity spectrum within an asset class or within an asset type, so that we can help our clients understand exactly where the opportunities are and being deliberate about that. So Dilari talked about some of the opportunities in the long only and then in the hedge fund space. Maybe you could tell us, banks stepping away from lending, lots of private companies need capital, and they're probably going to be looking to GPs for that. So tell us what we should expect within the private debt space for both dollars in the ground today and for future investments.
Yeah, absolutely. I think you're seeing the private debt market it's basically at an all-time high. And if you think about the overall growth in public and private credit, you are going to see, this market volatility is really driving some of the opportunities that we are starting to see. If we take a step back though and think about existing portfolios, as clients think about that before allocating to new opportunities, maybe looking at some of the liquidity guardrails framework that we've set out, making sure you can fund some of those capital calls, as well as making sure your existing portfolios are pretty healthy. But for those investors that I would say are pretty well capitalized, there are some interesting opportunities, I would say, across kind of private debt, with the caveat being a real focus on manager selection. So, regardless of the beta view, we still think that, accessing those the GPs with the highest quality are ones that you really want to focus on. And so these are GPs that, one, again, have sort of cleaner, smaller portfolios. They can play a little bit more offense. Two, there's some sort of sourcing edge, especially in the more competitive parts of the market. And then three, these are ones with dedicated and restructuring expertise. And so moving on, if we think about the types of opportunities for direct lending, you're starting to see unlevered yields closer to the kind of low double digits, which you haven't seen since the sort of coming out of the GFC. And then on the other side, on more kind of capital appreciation or total return types of strategies, whether it's opportunistic credit strategies or stress strategies, these are ones that are really going to take advantage of things such as defaults and downgrades picking up, maturity walls coming over the next couple of years, or overall just companies that need another capital infusion within their capital structures. But one thing that I would say too, tying into Dilari's comments, is really encouraging clients and investors to take a look at their portfolio to see where there might be overlap, particularly on the more on the strategies that are inclusive of more hedge fund and private debt, because we do expect that there are going to be kind of these crossover, whether it's by underlying collateral or actually the types of investments.
That's great. Thanks, Oliver. So takeaways that dollars in the ground might see some more markdowns, dollars that are already invested, but that opportunity is likely to come for really attractive entry points.
That's exactly right.
Awesome, thanks. All right, so let's shift gears to equities. And Will, I'd like to invite Will Ford to join us in the conversation. Will is a partner at NEPC and oversees our equity team across both long only and hedge fund equities. So Will, equities are a mainstay in most investors' portfolios. Can you tell us what you expect for active management in 2023?
Yeah, well, first I would say, consistent with our asset allocation team's work, we've seen the equity risk premium come down, meaning that's not an overly supportive market for ideas that are further out there on the risk spectrum, at least at this point in time. With that said, I think our view on active management is pretty bullish. Many of the headwinds that we've seen over the past decade, zero rate policy, a lower vol regime, the rise of passive management, a lot of those have now turned to tailwinds. So we think this could be one of the more attractive opportunity sets for active management that we've seen in some time. We've already seen some signs of this in 2022. 57% of the US large cap managers are currently outperforming the S&P 500. That's the second largest percentage in over a decade. And we've seen similar success across US small cap and mid cap.
That's a pretty big turn of events in terms of industry trends. So we've also seen a pretty major turn in factor exposures. We've seen reversal in factor performance. So what kind of strategies do you think are going to be most interesting today? Maybe contrast that to what's worked in the past 10 years.
Yeah, so growth, candidly had a really strong run, really up until the last 12 to 18 months, and we've seen a reversal of that and value leading the way. But moving forward, we think that strategies that have a focus on quality and income are the best suited to take advantage of a changing market environment. We think that those type of strategies and then their underlying companies who are more self-financing and have stronger balance sheets, those are going to be the ones that's rewarded moving forward. And so those are the type of strategies that we would lean into, but also in the areas of US small cap, global equity, and the emerging markets that we think are alpha rich.
Excellent. So your message on equities thus far is really not a home run from a beta perspective. The equity risk premiums come down, lots of opportunity for active management. and you're looking for more quality types of strategies when you are going active. So what about if you decide, if clients have a passive or an indexed exposure, what should they keep in mind?
Well, security concentration is definitely a growing concern, not only amongst within S&P, but probably most other equity indices when you're looking at kind of the weightings of the top 5 to 10 names. For example, the top 10 names in the S&P now make up nearly 25% of the index. And that's a similar story when you're looking at the MSCI ACWI or the MSCI EM indices, where their top 10 names there make up about 14 and 23% of those indices respectively. So, those investors, those clients who do decide to invest passively should really be wary of this and know that they are still making an active decision to kind of passively hold those exposures.
Excellent. Thank you, Will. So again, with that CIO mindset, we're going to shift from the tradable side of the equity spectrum to the illiquid side of the spectrum and invite Josh Beers to join us for the conversation. Josh is a partner at NEPC and head of our private equity group. So welcome, Josh. Lots to talk about today in private equity. Can you just tell us a little bit about the market dynamics today and what you're seeing in terms of valuations and deal activity and liquidity?
Yeah, absolutely. Thank you, Sarah. We're coming off a hot market since 2010. Fundraising, deployment, exits, and returns have all been up and to the right. We are expecting volatility going forward with less overall liquidity in the market. However, this should create new opportunities to arise, such as secondaries. That's a key place that we've been spending a lot of our time. We do think quality assets should start transacting at lower pricing. One of the things that we're absolutely pounding the table on is the best vintage years in this asset class tend to follow recessionary periods, which we think we're heading into.
Thank you, Josh. So that's a little bit word of wisdom, I think, in terms of how people should think about planning their year. Any other best practices that are that investors should keep in mind?
Yes, there is. And so with this asset class, do not try to time the markets. We recommend sticking to your pacing plans. Vintage year diversification does matter. If you do need liquidity, consider reducing commitments, not ceasing your commitments. This is especially true with your very best managers, as those tend to be harder to get back into over time.
Excellent, thank you. Okay, and now we'll shift gears again to Matt Ritter's team. Matt is a partner and director of our real assets team at NEPC. And he oversees real estate, infrastructure, metals and mining, and anything under the real estate, real assets umbrella. And we're going to hear a little bit about each area. So maybe, Matt, we could start with real estate. And would love to hear from you about which property types and which manager types you're most focused on this year.
Sure. Thank you. Well, first, just kind of setting the stage a little bit, I think a lot of people are aware of the fact that the real estate market today is facing some headwinds as rising interest rates have put pressure on cap rates. That in turn has led to reduced liquidity and debt availability in the real estate market. As a result, that's helping to inform some of the few key strategies that we're focused on in 2023. And I think the first thing I'll mention is that we think that right now is a compelling opportunity to be a real estate lender. Investors can take advantage of that higher interest rate environment, as well as the pullback of banks and other lenders, allowing them to potentially achieve, what had been considered a value add type of return, but with less risk. Now, on the equity side, we also think it's an attractive time to allocate to more nimble managers with broad investment mandates, particularly for those investors that have higher target returns. In other words, investing with a manager that has the ability to sort of shift their focus and go where the opportunity is, as we think this will be a quickly evolving market. Now, there are a few firms that we're currently evaluating that have a proven ability to invest not only across various property types, but across the capital stack as well. And then lastly, you asked about specific property types. We continue to favor what we refer to as sharpshooters. And those are managers that are focused on a single property type, be it residential or industrial types of assets, or they can be focused on a single geographic region. But the key is identifying those managers that are truly experts in their market.
Excellent. Thank you, Matt. There's a lot there to unpack. So how about within real assets? I know that energy transition has been a major area of focus and a theme that your team's been working on. So can you tell us what that means for opportunities within the energy transition realm?
Sure. Yeah. So energy transition, you're right, it continues to be a dominant theme, not only in the headlines, but in terms of investable opportunities as well. And I think a lot of times when people hear the phrase energy transition, what they think of is things like a new wind farm or solar generation. And that's definitely an important aspect. Global renewables capacity is expected to continue to grow rapidly over the next several years. But importantly, it's not just about supply. We also need to build or improve the supporting infrastructure to get that power where it needs to be and to utilize it efficiently. So that means investing in things like grid upgrades, battery storage technology, and the electrification of existing transportation and other infrastructure. And then there's the input materials as well. If we're going to have a true energy transition, we need more metals, as they're really needed for the continued electrification, grid upgrades, batteries, all those things I was just talking about. We believe that really paints a clear demand story for metals and mining. Meanwhile, new supply has been limited as banks and traditional lenders have been pulling back from the sector, which has in turn limited capital availability for new exploration in the mining sector. So in short, we believe there are compelling opportunities for private investment to capitalize on this energy transition theme across both the infrastructure and mining sectors.
Excellent. Well, thank you all very much for speaking today. And thank you everyone else who's joining us today. We hope this gave you a good sense for all of the work that our investment team is doing to find great returns for our clients. And we look forward to working with you in the years ahead.